Good afternoon. This is Sean Golding with Golding and Golding, here to discuss some of the basics for people who are U.S. persons that have assets, investments, accounts, or income in Australia. And so it's a very common situation we deal with here where someone will be a U.S. person, whether they're a citizen, legal permanent resident, foreign national who meets the substantial presence test, and they have various assets, accounts, investments, income in Australia, your Australian super. They may have ownership or interest in a private limited, various stock, mutual fund, and bank accounts. So let's kind of go through the basics. What makes Australia kind of difficult when you're doing your U.S. tax return is because it runs on a different year, July to June. So you got to take that into consideration when you're allocating income for your U.S. tax return. With baseline perspective, the U.S. taxes it's U.S. persons, not just citizens, on their worldwide income. So any income that you have generated in Australia is going to be taxable on your U.S. tax return. Even though that's true, depending on the situation, you may be able to limit or avoid some of those taxes. For example, if you work overseas in Australia, you may qualify for the foreign earned income exclusion and a subset foreign housing exclusion as well. Even if you don't live there, if you've got income being generated in Australia, but you paid tax, generally you can qualify for foreign tax credits. Now, something to keep in mind is franking credits usually don't apply in the U.S. because it's not the individual who's actually paying the tax. There is a treaty between the U.S. and Australia, so it's important to take a look at that treaty to get an idea of what income may be avoided, if there's different tax rates. Understanding that there's a saving clause, and that saving clause limits the treaty's application to U.S. citizens and residents depending on various factors. But even outside of the saving clause, it only applies to certain articles. It doesn't apply to the whole thing, of course, so that you may still be able to derive a benefit depending on what you're using it for. Looking at some of the basics, clients come to us when they're from Australia. They'll have bank accounts, investment accounts, mutual funds, life insurance policies, but not as common as some other countries like the UK and Singapore. One of the common things people come to us with is the stock accounts and superannuation. So superannuation, we have various presentations on that already. For the most part, it's reportable on the FBAR and the 8938. Whether it's reportable on the 3520 or 3520A is debatable depending on that new revenue procedure 2020-17. Whether it's taxed the growth, most people take the position that it's not. But, you should speak to some different tax specialists and see what they have to say about that. So, baseline perspective, income is taxable. Treaty may eliminate, avoid, or minimize some of that tax. Different types of investments we talk about. Let's talk about some of the different common forms that you have to file. Now, the FBAR is the one everyone seems to know about. It's not even a tax form, right? It's not even an IRS form. It's a FinCEN form. But it's filed electronically. It's due when your tax return is due, but it's on automatic extension. And it has a relatively smaller threshold, which just means if you add up all the values of your different accounts, not just each account, okay, you add them all up, and if the aggregate annual total on any day of the year exceeds 10,000 USD, you got to file the form, including any dormant accounts, inactive accounts, everything that you have, not just accounts over 10,000. That's a common misconception. Form 8938 is what the individuals and certain other filers use when they have to report under FATCA. FATCA is the Foreign Account Tax and Compliance Act. Form 8938 is actually part of your tax return. The FBAR is filed separately, directly with FinCEN. Form 8938 is part of your tax return, so if you file an extension, your Form 8938 would go on extension as well. Unlike the FBAR, Form 8938 has many different thresholds depending on whether you're filing single, married filing, separate, or joint, and whether you're considered a U.S. resident or foreign resident. Those are the two main forms. There are some more complicated forms. You may have an 8621 issue, which is PFIC, especially if you have some mutual funds or other types of equity funds, gifts and trusts. You may have a Form 3520, a Form 3520A requirement. Realizing those forms are due on separate days and have different forms required to apply for an extension. Form 3520A, you have to use a separate Form 7004, whereas the Form 3520, you generally just use what you would use to extend your regular tax return, your 1040, which is a Form 4868. There's entity reporting, if you have private limited sometimes, or Other types of entities, partnerships, you got a Form 5471, 8865. If you've got these problems and you didn't know there was anything you had to do, there are various amnesty programs you can use to get into compliance. Some of the more common programs are the Voluntary Disclosure Program, VDP, which is for people who are either willful or just can't, in good conscience, let's say, certify under penalty of perjury that they're non-willful. There's the Streamlined Domestic, Streamlined Offshore. They both fall under the moniker of the Streamlined Filing Compliance Procedures, Reasonable Cause, and Delinquency. We have lots of free information available on our websites. Main website is goldinglawyers.com. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.